For decades, excess corporate cash was treated like wasted potential. If a company wasn't investing aggressively, expanding capacity, acquiring competitors, or launching new products, it was often accused of lacking ambition. Cash sitting idle on balance sheets was seen as a sign of poor capital discipline. Today, that logic has flipped. Across corporate America, companies are holding record levels of cash, and they are doing it on purpose. This shift isn't about fear alone, and it isn't about a lack of ideas. It reflects a deeper change in how US businesses view risk, opportunity, and the cost of being wrong. Corporate America is sitting on cash instead of investing, because the environment has fundamentally changed the payoff structure of decision-making. The first driver is uncertainty that doesn't resolve quickly. In the past, uncertainty came in waves: a recession, a market correction, a policy shock. Then clarity returned. Today's uncertainty is structural. Interest rates, inflation dynamics, labor costs, geopolitical risk, supply chains, and regulation are all in flux at the same time. When uncertainty becomes persistent rather than temporary, long-term capital commitments become harder to justify. Cash becomes optionality. It preserves the ability to act later rather than locking the company into decisions that may age poorly. The second factor is the rising penalty for investment mistakes. Capital used to be relatively forgiving. If a factory was built too early or a product launch missed expectations, companies could absorb the loss and move on. Today, capital markets are far less patient. Missed forecasts, margin compression, or underperforming investments are punished quickly through stock price declines, activist pressure, and executive scrutiny. The downside of a bad investment has grown larger than the upside of a good one. In that environment, not investing can be the safer choice. Interest rates have also quietly changed the math. When money was cheap, holding cash felt inefficient. Zero-rate environments rewarded deployment at almost any cost. Now, cash itself has value. Treasury yields, money market returns, and low-risk instruments provide a meaningful return without operational risk. This doesn't mean companies are becoming banks. It means the opportunity cost of waiting has fallen. Sitting on cash is no longer a drag, it's a strategy. Another major reason is forecasting reliability. Large investments depend on accurate projections. Demand forecasts, cost curves, pricing power, and market growth assumptions. In recent years, those forecasts have become less dependable. Consumer behavior shifts faster. Enterprise spending cycles shorten. Technology adoption curves are more uneven. When forecasts lose credibility, executives hesitate to approve irreversible capital spending. Cash becomes a hedge against bad assumptions. There is also a structural change inside corporate governance. CFOs now wield more influence over capital allocation than at almost any point in recent history. Boards are demanding tighter controls, faster payback periods, and clearer downside protection. Projects that once passed with optimistic growth assumptions now face stress tests built around worst-case scenarios. Many investments fail not because they won't work, but because they are too confident. Cash survives these filters better than bold expansion plans. Labor dynamics play a role as well. Hiring has become a long-term commitment rather than a flexible cost. Training, benefits, retention, and compliance costs make workforce expansion harder to reverse. Companies that invest heavily often need to scale headcount alongside operations. Holding cash allows firms to remain lean and avoid locking in fixed costs that are difficult to unwind if conditions change. Supply chains add another layer of hesitation. Capital investments often depend on stable suppliers, predictable logistics, and reliable inputs. After years of disruptions, many companies no longer assume stability as a baseline. Investing without confidence in supply continuity introduces risk that cash simply does not carry. There is also a reputational dimension. Failed investments attract attention. Idle cash rarely does. Executives are evaluated not just on growth, but on avoiding visible failure. In today's environment, caution is rewarded quietly, while ambition is scrutinized loudly. This asymmetry nudges companies toward preservation rather than expansion. Importantly, sitting on cash does not mean companies have abandoned growth. It means growth is being delayed, staged, or redesigned. Instead of large upfront bets, Firms are favoring modular investments, pilot programs, and reversible projects. Cash enables these smaller, flexible moves. It allows companies to wait for confirmation before committing fully. Some firms are also holding cash defensively. They anticipate acquisition opportunities, distressed assets, or market dislocations. In uncertain environments, the best deals often appear suddenly. Cash provides speed. Companies with liquidity can act when competitors cannot. This behavior also reflects a shift in investor expectations. Many shareholders now value resilience as much as expansion. Balance sheet strength, liquidity buffers, and downside protection have become valuation drivers. Cash signals discipline, not indecision. Critically, this trend is not permanent, but it is rational given current conditions. When uncertainty declines, forecasts stabilize, and the cost of being wrong falls, capital will move. For now, corporate America is prioritizing survival quality over growth quantity. In a world where mistakes are expensive, flexibility is scarce, and reversibility is king, cash is no longer idle. It is strategic. Corporate America isn't sitting on cash because it lacks confidence. It's sitting on cash because confidence now has a much higher price. And waiting is often the smartest investment available.